So every day, Aaron, I'm seeing something that's a comparison to 87, like yesterday, Target. This is the worst day for Target since 87, or this is the most volatility since 2000, or this hasn't happened since 2008. Those are some scary years.
Yep.
Are we in any of those years right now?
You know, the one thing that I was looking at is stock dispersion, and that hasn't happened since 2008 and 2009. And that means that basically there's a massive difference between winners and losers, and it really is a stock picker's market. And you've really got to be in exactly the right positions. And we also haven't seen that since 2000. So it's crossed above 30%, which doesn't sound like a lot, but it actually means a lot when you're managing your money and which stocks to get into. And it tends to last a couple years. So this does.
But on one hand, this is good for your business in the sense that you both of you, well, first of all, you did the right thing. You either, you went to the safer names. I know you took, you got out of a lot of names. Yep. You saved your clients a lot of money. This makes a professional stock picker worth their salt. It
makes it a little harder. You can't just simply buy and hold. You've got to be a little more active and selective. But absolutely, it does for those that are willing to do the deep dive. There's some possibilities and some opportunities.
Right, but moving into, and we've said it so many times, top quality value names, trying to eliminate some of that stuff that was, exciting and sexy and all that. It was really a back to basics move. And I think it still is.
I never thought I'd be recommending like Constellation Brands.
Listen, but look, names like IBM, Johnson & Johnson, Coca-Cola, those are all big, boring, but they're beautiful names in this environment.
But here's the thing. Okay, so Warren Buffett has put about, he accumulated over the last 10 years, went from like 20 billion to 140 billion. He put $50 billion to work. I mean, does anyone want to implement Warren Buffett? Does anybody think they can buy something here and forget about if they're early, a month, 2 months, 6 months, that a year from now, 4 years from now, you'll be making a bunch of money? I mean, is anyone saying, hey, Kenny, find me those ideas?
Well, I think they're always saying, find me those ideas because they're all nervous.
I mean, the sense I get is like, and I hate this. Sometimes I feel like the guests come on and they don't want to say, hey, buy now because the market will go down. The next time they come on, they feel under pressure. Like, there's got to be something you're willing to buy now, even if it goes down near term.
Right, I agree. And that's the way I'm playing it, right? I continue to, when I buy on the weakness, right? I'm not chasing on the up days. I don't chase it. On the down days is when I add, but I add to the names that we've been talking about, right? So for me, and again, part of it reflects kind of my age and where I am on the risk scale, but they are those big quality dividend paying names, right? That we all know, the multinational.
Right. And so, Aaron, recession.
Yep.
There's debate going on. I know J.P. Morgan said the market suggests we're 70% in recession. I think most people watching believe in their own personal lives are already in a recession, so forget the semantics. Right. But why is it important? What's the distinction between a severe slump or recession when it comes to buying great stocks?
Well, I think what was interesting with JP Morgan's is they said the equity markets say 70%. The debt markets are saying like 30%.
Okay.
And so we've got this huge difference between which market says what. And I think when you sort of average them all out, it's sort of 50-50 at this point. Like whether you're looking at like what the debt
But is it important in the grand scheme of things?
I think what's important is that the equity market, most of the pain has been priced in. That 70% and so much higher means that this slump is getting us ready so that even if there is a recession, we're actually most of the way there, and there's a lot less pain to go down than in the debt market.
That changes the risk-reward dynamic.
Exactly.
The risk is being out of the market.
That's really the key takeaway.
The risk is always being out of the market, right? I mean, these people that, especially the retail traders that try to time the market, they want to sell it, they want to buy it, they want to try to time the bottom, time the top. Don't do that. Don't do that. Have a solid portfolio, know the names that you own and why you own them, and stick to the plan.
All right, so we got a brand new studio. You can see how beautiful it is.
Love this studio.
We also have a kitchen in the back.
When does that happen?